Okay, Louisa, thanks. Moody's cutting ratings on 15 banks, citing exposure to volatile capital markets. Cuts could push up borrowing costs and force the banks to post more collateral. B of A, RBS, HSBC, Lloyds, and SocGen were cut by one notch. A slew of others, including Citi, Goldman, JPM, Barclays, RBC, BNP Paribas, Credit Agricole, UBS, and Morgan Stanley were cut by 2 notches.
I'll breathe for you.
Thank you. Morgan Stanley had faced a possible 3-notch cut, which Moody's instead gave to Credit Suisse. Most of the banks say they disagree with the downgrades, not surprisingly, and that they won't have much impact on their funding costs. Joining us now on the phone for more from New York, we've got Bob Albertson, Chief Strategist at Sandler O'Neill, and here in the studio, John Allison, former CEO and Chairman of BB&T, now a distinguished Professor of Practice at Wake Forest University's School of Business. Bob, first to you, what are the practical implications of these cuts going to be? We're seeing bank shares hold up okay this morning.
Good morning. Almost none, really. It's rather stale news to decide that there's volatility in the market and that this would be damaging 4 months after they were talking about it. As you know and said, the numbers are pretty much straightforward. There is a narrow impact in the trading arena of banking in the U.S. that has limited impact. The derivative collateral issues are quite modest. The bigger story, I think, is the U.S. bank funding has not been this secure and deposit-rich really since the early 1980s. So I think when the Wall Street Journal calls it this morning a fresh blow to the financial sector, I would disagree.
John?
I agree with what Bob said, but I do think the downgrades reflect reality. These banks have had too high of ratings. You know, my bank is now a large bank, but when I grew it, it was a small bank, and we were much stronger than the bigger banks. And if we talk to Standard & Poor's, Moody's, and Fitch, they always said, well, you had to be bigger to be rated higher. So that they've always said that bigger was better, which in fact is not true.
That's an interesting point, Bob. Are we seeing more strength in U.S. regional banks than the big guys at this point?
I think John is right. We've kind of reversed the playing field. It used to be bigger was safer. Now I think they're frankly going a little too far in the other direction. But the U.S. banking industry outside of the trading business is really improving rather remarkably, and investors I don't think are paying attention to it because they've got revenue growth now from loan demand. It's small, but then we've also got revenue growth from loans in banks replacing non-banks, which you don't have much in Europe. 3/4 of our loan base in the United States is from non-banks, and that sector is the one that's sick.
But John, isn't interbank lending, though, tight across the board? Yes,
there is an integration of the banking system, but the regional banks in the U.S. aren't very dependent on the larger banks. There's a connected system, but it's a well-disciplined system. They manage the risk among the system. But I think there's a deeper issue here that people that's really underlying this whole euro thing. We've been running an experiment since 1971 where the U.S. dollar's become the reserve standard of the world, and it's been disconnected from gold, from a commodity that politicians couldn't control. So we've been relying on government bureaucrats who are supposed to be experts to set the monetary standard of the world. That's a riskier experiment. It may be better in that these guys may be wise or they may not be disciplined. And I think there's this underlying, it's not just the euro, it's you've got a monetary standard that's based on bureaucrats and elitists instead of disciplined by markets. And that's a risky experiment.
That warning is partly what you were talking about here in London last night. But I know Bob wanted to jump in here with a point. Bob?
Yeah, well, I want to pile on that same point. The big story out there is the problem is not banks, really, whether it's U.S. or Europe. The problem really is governments. And what we're going to face is a reality, not in the too distant future, where interest rates really have to go up and reflect the damage the governments have done. That's going to be the problem. That's the denial everyone's got to get over and kind of stop this bank bashing and focusing on risk here and stress test there. I think we've overdone that story.
What should be done, John?
I think we need to move to more private banking. You know, before 1913, the U.S. had a private banking system, and banks had about 50% capital, and they had very few low failure rates. We created central banks basically to finance governments.
Well, we did have a string of banking and serious economic crises well before 1913. In fact, all throughout the late 19th century.
That's actually a myth. From economic history, 1870, 1913, the United States had the biggest economic boom in the history of man. We integrated millions of rejects from Europe, and yes, we have corrections. They all were short and severe, and they got over with within a year or two, and we started growing again. We had the same thing in 1920. We had a really severe correction, and then we had an economic boom. The government didn't do anything. 1930, we had a correction. The government helped us, as they are helping now, and it didn't get over for 15 years.
I'm going to go back home and read more of my U.S. banking history.
You really need to study and particularly what's been
John and I are going to talk
today.
off camera here, I suspect, after this segment. But we so appreciate you coming by while you're in town here in London. Bob, thank you for your time as well. Sorry we didn't have more for that segment, but as mentioned, bank stocks holding up okay in the wake of those Moody's downgrades, widely expected downgrades that came out last night.
Yeah, still to come here on the program, we'll look ahead to the trading session on Wall Street after S&P 500 moves through the so-called death cross. Gracious.
All details after the break.